Okay, we'll continue with the problems. Students, am I audible to you? Can you see the screen? Can anyone reply
Yes,
yes, sir?
yes, sir.
Yes, sir. Okay, okay. So the previous problem, we will just do a quick recap and then we'll go to the next problem. So yesterday's problem, they had given probability of occurrence and the rates of return of two companies, that is Y and Z. We were supposed to calculate the expected rate of return, then the variance and standard deviation of two stocks. Then B part he has asked me is Y comparatively riskless. Then C part, if the financial analyst wishes to invest half in Z and another half in Y, what would it reduce the risk? For that, what we have done is we have taken the proportion of funds that will be invested in Z and Y will be 50% and 50%, that is 0.5 and 0.5. So what we have done here, first we have calculated the correlation coefficient, but to calculate the correlation coefficient, students, we have to first calculate the covariance. So how we have calculated the covariance? Summation of I is equal to 1 to n, probability into y minus y bar into z minus z bar. So we got the correlation coefficient to be equal to 0.22. So after calculating covariance, we have applied to the numerator over there in this part. That is covariance is how much? 0.22 divided by standard deviation of 12 divided by standard deviation of y and standard deviation of z, that is 6.3 into 8.6. Okay, now today we will go to the next problem. The problem I'll read, students, then what all parameter they have given, the data is concerned, I'll just list it out and then we'll try to understand what they have given and what we have to calculate. Okay, see, these problems are very, very simple, but first thing is you have to understand the given data. So X and Y corporations have the following expected risk and returns. So what they have given me, they have given me two companies, that is X and Y. So they have given me R, that is return of X, that is 15%. Then variance of X. Please understand, students, whatever I am saying, try to remember that. Sigma X square is what? Variance of X is 16%. And similarly, return of Y is 18%. What they have given, I'm just reading it out, okay? Then variance of stock Y is 25%. Then what is that? R xy is equal to 0.6. Can anyone tell me what is that? What is that small r over there? Yes. Correlation coefficient, right? That exists between x and y is 0.6. Then the problem still continues. The portfolio risk, that is standard deviation for a portfolio of 50% in each asset. See, they have given me 50% in each asset, that is 0.5 in X and 0.5 in Y, is 4.03. Students, please understand, the portfolio risk for a portfolio of 50% in each asset is 4.03. They have given me already. Determine the correlation coefficient that will be necessary to reduce the level of portfolio risk by 75%. So what is the expected return of the equally weighted portfolio? So it is a very, very easy problem. Students, am I audible to you? Can you see the slide? Is there any disturbance? Can anyone reply yes, sir?
Yes, sir. No,
Am
sir.
I audible?
Yes, sir.
Then why yes, the energy level is low whenever I'm asking question? Huh? What I should understand? So either two things I should understand, that I'm not audible to you, or you're not understanding what I'm saying, right? So please try to interact. Even if it is wrong, try to tell. Nothing to worry, okay? We'll see any other student. Few more students are there who are about to join. Okay. Yashaswini, kindly mute your audio, ma. Yashaswini Raichur, kindly mute your audio.
Sir, it's muted.
Muted. Oh, now it got muted. Uma, good morning. Kindly mute your audio. Okay. Okay. Now we will understand the problem and go for the solution of this. Now, students, they have given me two companies X and Y. The return of X and Y they have given. The variance of X and Y they have given. Then the portfolio risk standard deviation for a portfolio of 50% in each asset they have given is 4.03. Okay. Now, after understanding what we need to calculate, we will go for the solution. Now, the first part in the solution is a bit tricky here. What he has told me, a 75% reduction in risk. See, in the question he has told me, please understand the question. A 75% reduction in risk is what? They has given me the portfolio risk, that is standard deviation of the portfolio, that is equal to 4.03. So a 75% reduction in risk means what? So 0.75 multiplied by 4.03, which will come to 3.02%. So now the new level of risk will be 4.03 minus 3.02, which is equal to 1.01, which is taken as 1, which we can take for the problem as 1. Let me explain you now. All of you please see the slide, students. See, a 75% reduction in risk means he has given me in the problem, standard deviation of the portfolio is how much? 4.03. So 4.03 multiplied by 0.75, which is equal to 3.02%. So therefore, the new level of risk will be 4.03 minus 3.02, which is equal to 1.01, which can be taken as a round number equal to 1. Okay, this is the first part in this particular problem. This is see, all the problems what I am solving now, it is very important from the examination point of view. I am solving various type of problems so that given any problem, you should be in a position to solve. Okay. Now the next part is calculation of the standard deviation of the portfolio. The moment I say sigma p means what? Standard deviation of the portfolio. Now if I ask someone what is sigma p square, variance of the portfolio. Okay, so now in this problem they've asked me to calculate the standard deviation of the portfolio. Sigma p is equal to, remember that a plus b whole square, a square plus b square plus 2ab. In the similar way, I'm taking this x, that is proportion of funds to be invested, and standard deviation of x plus xy, sigma y square plus 2 into x1 x2, correlation coefficient sigma x into sigma y. Now standard deviation of this portfolio we have just calculated, that is equal to 1. 1 I am putting here, which is equal to square root of the proportion of funds to be invested is how much they have given me? 0.5, right? So 0.5 in each fund, that is x and y. So 0.5 square multiplied by 16. Okay, sir, where they have given 16, sir, in the problem? They have given here sigma x square, that is variance of the variance of security x and variance of security y. They have given, right? So variance of security x is how much? 16%. Similarly, variance of security y is how much? 25%. They have given in the problem. Straight away apply those values here. Plus 0.5 square multiplied by 25 plus 2 into 0.5 into 0.5 into correlation coefficient we have to calculate now, multiplied by 4 into 5, right? Now students, what I have to do is, so I need to remove this square root, or I need to calculate the value. So what I do, either I do squaring on both the sides. See students, this is concerned, this is called as left hand side, and this is called as right hand side. In this equation, 1 is equal to square root of, okay? So what I do, square root of 1 is equal to 1 itself. So now I request all of you to solve this. 0.5 square multiplied by 16 is equal to 4. I'm solving this now, students. So 0.5 square multiplied by 25 is equal to 6.25, and then 0.5 into 4 5s are how much? 20 r. I'm retaining the like this because on the right hand side this r is there. I need to calculate this r, right? So what I do now, 4 plus 6.25 is how much? 10.25 plus 20 multiplied by 0.5 is how much? 10 r. Now what happens? Since I need to calculate what is there on the right hand side, r is equal to minus 9.25 divided by 10. I'm repeating. So what happens here? Right hand side is concerned. 10r is equal to 1 minus 10.25, which is equal to minus 9.25. Then r is equal to minus 9.25 divided by 10. So minus 9.25 divided by 10 is how much? Minus 0.925. So till here in calculation, if you have not understood, please ask me. Please ask me frankly. There's nothing to. Students, the calculation is concerned. Till here, everyone has understood, or shall I repeat once again? See, students, whenever you are solving this equation, one where my cursor is there, this is called as left hand side, and this side is called as right hand side. Okay. So what I do, square root of 1 is equal to, how the square root come? Either I can do squaring on both the sides, squaring in order to remove the square root, right? So when I do squaring on both the sides, this will become square root of 1, which is equal to 0.5 square into 16 is 4, 0.5 square into 25 is 6.25, then 2 into 0.5, that is 0.5 into 20 r. R is what? The correlation coefficient that exists between two stocks, which I need to calculate now. Now, what happens here is R is on the right hand side, right? So I need to calculate this R. So what I do, 10R is equal to 1 minus 10.25. When it goes to the left hand side, see, remember this, when it goes to the left hand side, the sign changes. So 1 minus 10.25 is how much? Minus 9.25. Then R is equal to minus 9.25 divided by 10. So the value of R is how much? Minus 0.925. Then portfolio return, RP is, how do we calculate the portfolio return? So return of, 1 minute students, return of stock X into the proportion of funds that has been invested, that is X, plus return of stock Y into the proportion of funds that has been invested. So whether they have given the return of X and return of security Y, yes, they have given in the problem, right? So return of security X is 15%, return of security Y is 18%. They have given. So 15 multiplied by 0.5 plus 18 multiplied by 0.5, which is equal to 16.5. So this is called as return of the portfolio. And this is what they have asked me to calculate, that is correlation coefficient that exists between the two stocks. Student, any doubt here, please ask me. I think few might be getting difficulty in calculating this part, right? So everybody, when you are calculating, you are getting the value of R minus 0.925. Today the energy level is down, students. I don't know the reason. Huh? Please let me know. Yes, sir. No, sir. Sir, I am solving, sir. Something you have to reply, right? Anybody?
So got minus 9.25.
Yes, sir. Yes, sir.
Minus 0.925 you are getting?
Yes, sir.
Okay. Others? All are getting
Yes, sir.
right?
Same.
Okay. Okay. So in this problem, what we have done is, first we have calculated the correlation coefficient, that is minus 0.925. Then we have calculated the portfolio return, that is 16.5. So next we will go to the different type of problem. So what they have given me is, first let me read the question and identify what all parameters they have given. So two assets A and B have the following risk and return characteristics. They have given me two assets A and B which have the following risk and return characteristics. So return of A is 22. Similarly, return of B is 20. then standard deviation of A is 15 and standard deviation of B is 18. Then correlation coefficient of AB is equal to -1. Now, please remember this is, I'm telling these are the problems which have been asked in the previous paper. Okay. So determine the minimum risk portfolio for A and B. Remember, I have rounded this correlation coefficient. When correlation coefficient is -1, and when they ask me to calculate the minimum risk portfolio for A and B, so what I do is first, how do I obtain minimum risk portfolio? First thing is, when the correlation coefficient is negative, can I reduce the risk associated with the portfolio? That is my question to you. When the correlation coefficient is negative, can I reduce the risk associated with the portfolio? Yesterday we had solved one problem, right? So we came to a conclusion that when the correlation coefficient that exists between the two stocks is negative, then the portfolio risk can be reduced. So one thing we came to know that we need to find out the proportion of funds that has to be invested in security A and security B, right? So what I do is I use this particular formula, that is XA is what? Please remember this. XA is the proportion of funds that has to be invested in security A, okay? So how do I calculate the proportion of funds? Sigma B divided by sigma A plus sigma B. So when I'm using this particular formula, when the correlation coefficient is -1, and when they ask me to calculate the minimum risk portfolio, so first thing is I need to calculate the proportion of funds that has to be invested in security A. So what I do, I calculate XA is equal to standard deviation of B divided by standard deviation of security A plus standard deviation of security B. Now they have given me all the values. Standard deviation of B is how much? 18 divided by standard deviation of A is 15 plus 18. So I got the value, that is XA, to be equal to 0.545. 0.545 multiplied by 100, which is equal to 54.5%. Students, especially in such problems, it is very easy. The total proportion should be equal to 100. Okay. So what I have calculated now, the proportion of funds that has to be invested in security A. How much I got? 54.5%. Now, what is the proportion of funds that has to be invested in security B? It is very simple. 1 minus 54.5 or 1 minus 0.545. I get the value to be equal to 0.455 multiplied by 100, 45.5. So these two values should be exactly equal to 100%. Then only my answer is correct. Okay. So what is my minimum risk portfolio? When the proportion of funds invested in security A is 54.5%, that is 0.545, and when the proportion of funds that has to be invested in security B is 0.455, that is 45.5%. So the total proportion should be always equal to 100%. Now, what things I have explained to you, students? They'll give me two assets. They'll give me return of security A, return of security B, standard deviation of A and standard deviation of B. They'll give me correlation coefficient, that is -1. That means what? That means these two stocks are negatively correlated, right? So they have asked me to calculate the minimum risk portfolio for A and B. So minimum risk portfolio. So how do I calculate? First, we have to calculate the proportion of funds that has to be invested in X, that is security A. Then proportion of funds that has to be invested in security B. So these, if I invest in this proportion, that is 54.5% and 45.5% in stocks A and B, then I can get the minimum risk portfolio. Students, understood?
Yes, sir.
1 minute.
Yes, sir.
Okay, we'll go for the next type of problem, that is problem 8. The SAL and GAL corporations have the following risk and return status. The SAL and GAL corporations have the following risk and return status. So what they have given me is the return of SAL, that is SAL stock is 15%, and similarly the return of GAL is 17%. The standard deviation of SAL is 30%, and the standard deviation of GAL is 25%. Now I have marked one more thing over there. The correlation coefficient that exists between the SAL and so these are two different. In the previous problem, students, we saw the two stocks were perfectly negatively correlated. I'm repeating once again, the two stocks were perfectly negatively correlated. So what we have done, we have used this particular formula to find out the proportion of funds that has to be invested in security A and security B. Okay, but here what has happened, the correlation coefficient that exists between the SAL and JAL, that is the two stocks are concerned, it is 0.5. So in this case, we have to find out the minimum risk portfolio. First thing in the examination when they give, you have to check what is the correlation coefficient that exists between the two stocks. If they are positively correlated, like 0.5 or 1, then you need to use one formula. If they are negatively correlated, you should use sigma A, this one. First, we have to calculate XA is equal to sigma B divided by sigma A plus sigma B, okay? Now, we will see how to calculate the proportion of funds that has to be invested in SAL and GAL. Please see, students, excess is what? The proportion of funds that has to be invested in SAL. See, each unit is concerned. Unit 2, Unit 3, Unit 5, and Unit 6. 4 units where problems are there. You should please list down the formulas so that you can remember it. You please see it very often so that you will not forget these formulas, okay? Because in the examination, now it is okay. Now you can understand every problem in a easy way. But in the examination, a problem will be picked. So first thing is you'll be confused, like which formula to be used and what exactly I need to calculate, okay? So in order to avoid that, I request all of you to list down few formulas, right? Now, first thing is excess. That is what? The proportion of funds that has to be invested in SAL. So sigma G square minus correlation coefficient ES that exists between S and G, standard deviation of SAL and standard deviation of G whole divided by sigma S square into sigma G square plus 2 into correlation coefficient that exists between SG into standard deviation of S into standard deviation of G. See here, this entire thing which is there in the numerator, it remains the same here. Okay, so only 2 will be added here. Now excess is equal to whether they have given me in the problem. See, they have given me sigma G square, that is 25 square. But here they have given, please understand, students, they have given me standard deviation here. They have given me standard deviation of G, that is 25%. They have given me standard deviation of S, that is 30%. So what I am doing here, 25 square minus correlation coefficient, that is they have given me 0.5 multiplied by 30 into 25 whole divided by 25 square plus 30 square minus 2 into 0.5 into 0.30 into 25. Okay, so when I do this, I request all of you to do. So 25 square is how much? 625 minus 30 into 25 into 0.5, which is equal to 375 in the numerator. Okay, similarly 25 square is 625 plus 30 square is 900. See here, 25 square plus 30 square minus, see in the formula there is a small mistake here which I have taken. So it has to be sigma S square plus sign is missing, sigma G square minus, it has to be minus, students. See, it is correct. This is perfect. I request all of you to change it. This is perfect. Okay, only in the formula it has to be plus sign here and minus sign here. Okay, see 25 square plus 30 square minus 2 into correlation coefficient that exists between the two stocks, they have given me 0.5 into standard deviation of SAL, that is 30, into standard deviation of G, that is 25, which is equal to 625 minus 375 in the numerator whole divided by 25 square is how much? 625 plus 30 square is 900 minus, please do this calculation and check, 2 into 0.5 into 30 into 25, which is equal to 750. So 250 divided by 775, which is equal to 0.32, multiplied by 100, 32.26%. So this proportion of funds has to be invested in the stock SAL. In the problem, they have given me two stocks, right? SAL. Right? So it is obviously 1 minus 32.6. The 1 minus 0.3226, which is equal to 0.6774. So obviously, when I add 32.26 plus 67.74, it is to be 100%. Okay. So today we have solved the two types of problem. The first thing is, when they give me the correlation coefficient value that is negatively correlated, so when they ask me to calculate the minimum risk portfolio, so I use XA, that is the proportion of funds XA is equal to standard deviation of B divided by standard deviation of A plus standard deviation of B. The second problem, when the correlation coefficient that exists between the two stocks, that is SAL and GL, is 0.5, when they ask me to calculate the minimum risk portfolio, then I use here in the formula, students, sigma S square plus sigma G square minus 2 into correlation coefficient of SG into standard deviation of S into standard deviation of G. So first, what I calculate the proportion of funds that has to be invested in excess, that is 32.26%, and XG minus 1. XG is equal to 1 minus XS. So 1 minus whatever value I've got here, that is 0.3226, which is equal to 0.6774, which is equal to 67.74%. Okay. So till here everyone has understood. Shall I go to the next type of problem or any query here? Please ask me. Someone has messaged in the chat box. What is that? Okay. Students, shall I go for the next problem?
Yes, sir.
Okay.
Yes, sir.
1 minute. I'll drink water. Okay. Students, the next type of problem was earlier not there in your syllabus, but now this time they have included in the syllabus. That is related to the Sharpe's single index model. Okay, this is very, very, very important and interesting problem also when it comes to the construction of optimal portfolio, right? So very, very bit lengthy problem also, and a very important and interesting problem. Okay, first we'll try to understand what they have given. An investor wants to build a portfolio with the following 4 stocks. Which are the 4 stocks they have given? Just for example, don't, if your name is there, don't please mistake. You can say Sneha, Neha, Asha, and Priya. These are the 4 stocks. With the given details, find out the portfolio return and portfolio variance. Students, I'm telling, they have given me 4 stocks. They have asked me to calculate what portfolio return and portfolio variance. So that is RP and sigma P square. I'm repeating, RP is portfolio return and portfolio variance is what? Sigma P square. The investment is spread equally over the stocks. Very good. Now you tell me what is the proportion that has been invested in each stock?
0.25, sir.
Oh, fantastic. Since there are 4 stocks, the proportion of fund that has been invested in each stock is equal. That means 25% in first company, 25% in second company, 25% in third company, and 25% in fourth company. Okay. So what they have given me is they have given me the value of alpha, then beta of each stock. Then the third value is called residual variance. Now, what is this residual variance? I'll explain you. Symbolically, it is written as EI square. Okay, this is a very important problem. Please understand, students. So, residual variance of Sneha is the company Sneha is 45.15. Residual variance of Neha company is 132.25. Residual variance of Asha is 196.28. And the residual variance of Priya is 51.98. Now, what is this residual variance? It is also called as unexplained variance or error variance. It is the variance of any error or residual. See, the exact definition, it depends on what type of analysis we are performing. In statistics, a residual refers to the amount variability. It is nothing but a residual variability in a dependent variable that is left over after accounting for the variability explained by the a residual value is a measure of how much a regression line vertically misses a data point. Then what is this alpha? Beta, all of you know this this particular column. Beta of Sneha is 0.93. So what is beta? Yes, anybody? Beta is a measure of stocks volatility in relation to the overall market. I'm repeating once again. Already we have solved the problem related to this. Okay. Beta is a measure of stocks volatility in relation to the overall market. So if a stock moves less than the market, the stock's beta will be lesser than 1. So high beta stocks are supposed to be riskier but provide higher return potential. Then low beta stocks pose less risk but also lower returns. Now, what is this alpha? Actually, the first column here, alpha. Yeah, this particular column. What is alpha? Alpha measures the amount that the investment has returned. Please understand this. Alpha measures the amount that the investment has returned in comparison to the market index or other broad benchmark that is compared against. So whereas beta is what? Beta measures the volatility of a stock with respect to the index, whereas alpha measures the amount that the investment has returned in comparison to the market index. Okay, so these are the three values what they have given in the table. Now one more thing where what they have given, please remember this market return they have given. So overall market return is how much? 11. Overall market return is 11. Market return variance. Please remember, market return variance is 26. Symbolically, how can we write it as sigma m square? So when I write sigma m square, it is called as market return variance. Okay. Whereas RM is what? Market return. Now, students, what is RP? When I say, okay, calculate RP, what do you mean by RP? Anybody?
Portfolio return, sir.
Fantastic. Portfolio return. Then what is sigma P? Sigma P.
Standard deviation of portfolio.
Standard deviation of the portfolio. Then let me ask you individually then. Only one student is answering. Others are what? Okay. Steven.
Yes, sir.
Steven, what is sigma P square? when I say calculate sigma p square of the portfolio, what do you mean by that? Sigma p square.
So the measure of the risk of portfolio.
A, variance of the portfolio. Sigma p is what? Just now she told. Sigma p is standard deviation of the portfolio. Sigma p square is what? Variance of the portfolio. Please understand this, students, okay? And Steven, what do you mean by RP? When I say calculate RP, what is that? Steven, am I audible to you?
Yes, yes.
What is
Proportion.
RP?
Proportion.
Huh?
Proportion, sir.
A, RP is return of the portfolio. RP is return of the portfolio. Sigma P is standard deviation of the portfolio. Standard deviation means what? A risk associated with the portfolio. Okay. Now, Kedar, good morning.
Very good morning, sir.
Yeah. When I say XA and XP in the problem, what is that? X, when I use the symbol previously, I've used in the problem. X is what? XA and XB. Yes, anybody? In the previous,
Proportion.
yeah, why you people are not concentrating? It is the proportion of funds, correct? No, proportion of funds that is invested. Please, you have to be very, very much perfect here. Okay. Okay, I'll solve this problem now. So what they have given me, alpha, beta, then residual variance. It is symbolically called as EI square, and then market return is RM, and then market return variance is sigma M square. Students, am I audible to you? Can anyone say yes, sir? So that I'll start the solution of this particular problem. Am I audible to you?
Yes, sir.
Okay, perfect. Now, first, students, what they have asked me to calculate, portfolio return. 1 minute. Okay, portfolio return. How do we calculate portfolio return? So RP is equal to summation of I is equal to 1 to N. X is what? The proportion of funds invested into alpha plus beta into RM. See, when they have given me alpha, I'm using this particular formula, that is RP is equal to summation of I is equal to 1 to N. X is what? The proportion, that is X into alpha plus beta into RM. So in the first case, we have to solve it for all the 4 stock, students. Okay. So 0.17, nothing. See the value I'm writing here, 0.17 alpha plus beta is how much? 0.93. Please see my cursor here. Alpha plus beta into RM, that is market return, that is 11. I'm repeating. Okay. For the second company, Neha, can anyone tell me what is the value I should take? 2.48 plus 1.37 multiplied by 11. Alpha plus beta into market return. Similarly for Asha, that is Asha company, how much I need to take? 1.47 plus 1.73 into 11. Similarly for the last company, how much I should take? 2.52 plus 1.17 multiplied by 11. Okay. For the first company, I got the value to be equal to 10.4%. For the second company, I got the value to be equal to 17.55. For the third company, that is 20.5. And for the fourth company, it is 15.4. Then what is portfolio return RP? It is the summation. As Kedar mentioned, the proportion of funds that has to be invested in all the 4 stocks is how much? 0.25. So what I do here, 10.4, what I've calculated, multiplied by 0.25, 17.55 multiplied by 0.25 plus 20.5 multiplied by 0.25 plus 15.4 multiplied by 0.25. So the return of the portfolio is how much? 15.965. I'm repeating, the return of the portfolio is 15.965. Now, what else they have asked me to calculate? Market return variance. I'm repeating here, market return variance. So first we'll calculate the variance of the portfolio. Variance of the portfolio when they have given me alpha, beta. So summation of I is equal to 1 to n x into beta multiplied by variance of the market plus summation of the summation I is equal to 1 to n x into the residual variance, that is ei square, where sigma m square is what? Variance of the index or variance of the market, and ei square is what? Residual variance. Now, this is important formula, students. Make a table of this, okay? Sigma p square is equal to summation of I is equal to 1 to n x1 into beta's whole square into variance of the market plus summation of I is equal to 1 to n x1 square into ei square. Now, what I'll do is I'll only take this value and calculate, students, for all the 4 stocks. So, summation of I is equal to 1 to n x1 into beta 1 whole square, which is equal to, so what is the proportion of funds that has been invested in each stock? 0.25, right? So 0.25 multiplied by, see, beta value 0.93, 1.37, 1.73 and 1.17 I need to apply here. So 0.25 multiplied by 0.93 plus, when I use the symbol summation, plus symbol will come for each stock, okay? 0.25 multiplied by 1.37 plus 0.25 multiplied by 1.73 plus 0.25 multiplied by 1.717 whole square. Okay, so how much we will get? We will calculate very fast, and so 0.25 multiplied by 0.93, which is equal to 0.2325. Okay, 0.25 multiplied by 1.37, which is equal to 0.3425. 0.25 multiplied by 1.73, which is equal to 0.4325. 0.25 multiplied by 1.17, which is equal to 0.29. Whole square of that is how much? 1.3 whole square, or directly you can write here 1.69. Correct? 1.3 whole square is how much? 1.369. So what we are calculating now, only this part we are calculating. So we have to multiply that with variance of the market. So how much they have given me variance of the market in the problem? See here, they have given me market return variance is 26. So whatever value we have got here, we have to multiply 26 for that. 1.69 multiplied by 26. We get the value of this first part is 43.94. Okay? 43.94. That is 1.69 multiplied by 26, 43.94. Now I will go to the calculation of this part. That is, the second part is concerned. So summation of I is equal to 1 to n x1 square into ei square. Ei square is what? The residual variance. Okay. So 0.25 square into 45.15 is 2.822. 0.25 square into 132.25 is 8.266. 0.25 square into 196.29 is 12.269. 0.25 square into 51.98 is 3.249. So I got the second part of the formula, that is 26.606. Correct? This part. Now what I do is I add the first component and the second component to get sigma p square, that is variance of the portfolio. So 43.94 plus 26.606 is how much? Variance of the portfolio, that is 70.546. So when I want the standard deviation of the portfolio, how much? It is square root of 70.546. Square root of that is how much, students? It is 8.399. So I got the standard deviation of the portfolio to be equal to 8.399. I'll repeat this problem once again, students, so that you will understand this. What they have given me, alpha, beta, and residual variance. Then they have given me market return and market return variance, that is sigma m square, which is equal to 26. They want me to calculate, the first part is, with the given details, find out the portfolio return and portfolio variance. So first what I do, I calculate the portfolio return using the formula summation of I is equal to 1 to n xi into alpha plus beta Rm. So they have given me xi, that is alpha, they have given me 0.17 plus 0.93 into 11. So first what I calculate the return of each stock, then I calculate the portfolio return. Since they have given me the proportion of funds to be invested in all the 4 stocks to be equal to 0.25, so I use multiplied by 0.25, 0.25 and 0.25 and 0.25, that is equal to 100%. Okay. Then I calculate the variance of the portfolio. Summation of I is equal to 1 to n, x1 into beta 1 whole square into variance of the market plus summation of I is equal to 1 to n, x1 square into residual variance square, that is EI square. So I calculate the first component, then I calculate the second component. I add these two components, I get what? Variance of the portfolio. So variance of the portfolio is how much? 70.546. Then they have not asked me to calculate the standard deviation, but for your reference, for your understanding, I'm telling standard deviation of the portfolio is equal to square root of 70.546, which is equal to 8.399. So you should be knowing what parameter they have given me in the problem. Based on that, you can start solving. So I will, students, any doubt here in the problems, whatever we have solved today? If no doubt is there, then I'll end the session. Students, be very frank. Okay. Okay, thank you so much to all of you. The video of the same will be shared to all of you. Yeah, and when you are solving the problem also, if you are getting any doubt, just message me or WhatsApp me so that I'll get back to you with the solution for your doubts. Okay. So thank you so much. Ahead. Bye-bye and take care.
Excuse me, sir.
Yeah, you have a query?
Sir, we did not
Sorry.
get Thank you, sir. module 4 note. Hello.